You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and Jill Malandrino.
All right, everybody. That music means it's time once again for Options Bootcamp, the program here on the old Options Insider Radio Network, where we break down the sometimes scary, sometimes just downright weird world of options and explain how you can utilize them in your own portfolio. Maybe you want to hedge, maybe you want to do a little defense, maybe you want to generate some income, maybe you want to speculate, maybe you want all of the above. Well, we can walk you through that. My name is Mark Longo, of course, from the aforementioned network, as well as, of course, from theoptionsinsider.com. And wherever you're listening to this, could be iTunes, Stitcher, could be live. We're doing a little live stream for you hardcores like to pop up in the middle of the week, listen to our shows live as well. Make sure wherever you're listening to this live after the fact, make sure you hit us up, questions, comments. We do like to hear from you guys. And if you like what you hear, feel free, if you're so inclined, leave a nice little review. Maybe you like my stuff. Maybe you're not a big fan of Passarelli. I understand how however you want to couch your review, feel free to put it in there. The more the merrier. That always helps with search and everything else that goes on all those different platforms. You wouldn't believe how complicated a podcast search is on a simple thing like iTunes would be. It gets a little crazy sometimes. So the more the merrier when it comes to that. And of course, like we said, you can always join us live. If you have our Mixler link, just grab it, set it and forget it, or you follow us in Mixler. You'll be notified the second we go live, and you too can join the live party. That is Options Bootcamp. Speaking of the party, I got 2 people joining me here on this party today, both of them by that mystical, magical 19th century technology known as telephone. Let's start off with the black-hatted one himself, the yin to my yang, Mr. Dan Passarelli, the founder of Market Taker Mentoring and the author of many seminal options tomes, including Trading Options Greeks, I believe is the title, and a few others, which I'm sure he will fill me in on post-haste. Mr. Passarelli, welcome back to the show, sir.
Hey, I'm always glad to be back on the show. Hello, everyone out there in Internet Radio land.
And just for clarification, what are the names of your books again?
There is Trading Option Greeks, which is in its second edition. You got that one?
I got that one right. I said yes. I have it here. Yes, but I got the name right.
Yeah, and it's in its second edition. It's published in simplifying Chinese. I want to point out, and the other one is The Market Taker's Edge.
There you go. Check them out over there on Amazon or wherever you find your favorite book purveyor. Maybe your local bookstore has them. Who knows? You never know. Mr. Passarelli, lots of fun ways to spell it this way. 2 S's. And then only 2 L's at the end as well. So 2 S's, 2 L's. Get that in mind when you're doing your book searches. All right. And also joining us from the markets mecca of New York City. In fact, the markets mecca of the markets mecca. They're right at the NASDAQ markets hub there in the heart of New York City. We are joined by Jill Malandrino, the global markets reporter over there at NASDAQ. Jill, welcome back to the show. How are things in NASDAQ land?
They are going very well, thank you. And I'm lucky. I actually have a signed copy of one of Dan's books.
Oh, well, you should put that on eBay.
I'll put that on eBay, right?
I'll expect you to be looking for bids while the show is going on. I think you can get a whole maybe 35 cents. Maybe I think in China it's big. So like 75 cents over there. It'll be huge. Big dollars. Big dollars. All right. And actually, Jill, you are to blame for our topic this week because you guys have been talking a lot about expiration over there and all the many nuances and misconceptions and issues that surround all things expiration. So we thought, what better thing to do on this show than maybe tackle some of those myths and misconceptions, do a little expiration myth busting. So without further ado, let's dive right on into our basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
Always love that music. Makes me feel like 4th of July, even here in the heart of December here in Chicago. And, of course, welcome to the basic training portion of the show where we break down, as the name implies, some basic options concept that you can utilize in your own portfolio. It doesn't get much more basic than expiration. It's a very fundamental part of the whole options trading process. And Jill, like I said, since this is your baby, since this was something you guys have been working on quite a bit over there at NASDAQ of late, I'm going to be leaning on you pretty heavily throughout the episode for your expiration expertise. But let's start nice and top level. And we may have some people out there, like we said, a lot of newcomers come to this show, tuning into this show, learning about options, maybe for the first or second or third time, not still familiar with the concepts. They're used to buying and holding stock and being able to do so forever. Now, the concept of options and their expiration may be a little bit confusing or intimidating to them. So why don't you explain to them, Jill, what is this thing we're talking about, expiration, and why the heck do these options expire? Why do they go away?
Well, it's really interesting. Options trading, particularly expiration, is something very near and dear for us at NASDAQ as we host live content from 9:30 to 4 on Expiration Friday, the last quarter of each month, which is known as Quadruple Witch. So we will be there again this Friday, December 15th at the Philex Live Options Trading floor. And we'll get into Quad Witch a little bit later. But, you know, one of the most basic components of options is the time value of it, right? So when you look at a basic options chain, you're going to see the amount of contracts you have, the underlying, you're going to have your strike price, you're going to have your cost per contract, and the other piece that's in there, the fifth piece, is when it will expire. Now, regular way options expiration is the third Friday of each month. Of course, now we have a whole multitude of different kinds of contracts, which allows more products for traders to work with. We also have weeklies, we have quarterlies, and so forth. But you know, the most basic thing about options trading is that time component. And whereas holding a stock could technically be finite, when you're trading an options position, you technically have a limit to how long that contract actually lives for.
Dan, you know, obviously you deal with a lot of newcomers over there at Market Taker Mentoring. How much of an obstacle, how much of a hurdle is that to a lot of these newcomers? This notion that, you know, they not only have to be right in whatever their estimation is, could be direction, could be volatility, et cetera, but they also have a finite window in which they have to be correct in. How is that a big stumbling block for a lot of the newcomers who come to you and trying to learn about options, particularly when they come from stocks, a place where they really don't have that ticking clock? Because everyone knows if a stock trade goes against you, suddenly it's a long-term hold. So you don't have that luxury in the options world. How big of a deal is that for newcomers to options?
Yeah, the old, I'm not a trader, I'm an investor now. Timing is everything, man, when it comes to trading. So, yeah, like this idea that they've got to get it within the right window is extremely important. And, you know, then once people recognize that nuance and get over that mistake of maybe not giving themselves enough time, you know, sometimes people can make the other mistake and, you know, say, oh, well, I'm just going to give myself a whole bunch of time. I'm going to sell one of these 6-month credit spreads. And then, like, that's just way too much time because their theta is tiny and so much time with the trade to go against them. So, yeah, man, picking the right expiration is such an important nuance.
And you just mentioned theta, so we got to mention the impact of expiration. As you might imagine, listeners, the day your options expire and how close or how far away you are from that date has an impact on these little things we like to call the Greeks. Of course, your delta, gamma, theta, vega. Sometimes sometimes row, though these days a little more row perhaps than a couple of years ago, but still not allowed to row. Red more of the redheaded stepchild of the options Greeks. But that said, Dan, you did literally write the book on trading options Greeks. Give our listeners a little overview of how this mythical, magical thing known as expiration day, what that does to really mess with the Greeks.
Oh man, it does everything. I mean, the one that I think a lot of people who have some experience with options think about is the impact on theta, but it affects all the Greeks. As far as theta goes, what we're talking about here for some of you newcomers, that's called time decay or erosion. And theta is the Greek that measures that, which is extremely important because if you're putting on a trade that, is intended to profit from time passing, do you want a little profit or a big profit? Well, you want a big profit, so you got to select the highest theta. But, the time to expiration messes with gamma too. The less time to expiration, the bigger the gamma for near the monies. Messes with delta. The more time till expiration, the more the delta tends towards 50, the less times to expiration, the more it tends to 0 or 100, messes with vega, messes with rho especially.
Yeah, it's one of those things that expiration does play with everything pretty much. You're right. As you go farther out, as you extend that expiration date, things change. As you get it closer to expiration, a lot of people, as you mentioned, are mostly familiar with the impact. They see it in terms of theta. Of course, you get closer to expiration, that theta tends to ramp up, particularly for the at-the-money strikes, and we start to see that near exponential curve kick in. That's what a lot of premium sellers like to harvest. That's why they play in the weeklies and monthlies, because they get that nice kick up to the exponential portion of the curve, which is very attractive. Of course, very dangerous, too, because your gamma explodes. Theta and gamma, two sides of the same coin, and if your theta is exploding, guess what? Your gamma is exploding too. Dan and I, when you and I first walked on the floor of the SIBO back in the 90s, it was almost an impossible thing to really model your gamma and your theta accurately on expiration week. In fact, most of the guys I knew, as you approached at expiration Friday, pretty much threw their sheets or their handheld, whatever they had, out the window, because particularly when it came to those two Greeks, because modeling those, you were just approaching infinite on every level, and it was kind of just madness. And so you didn't pay attention to it. You kind of had to have an intuitive gut sense to handle that. Modeling systems a little bit better now, but still it is tricky to do those types of Greeks. And of course, things like delta, as Dan mentioned, change with the expiration date, vega, all this fun stuff. Rho is all about timed expiration. The more timed expiration you have, the more rho can be an issue. If you have a weekly, guess what? Interest rate's probably not going to matter too much to you. If you have a 5-year option, rho is a different animal. So it's all about days to expiration when it comes to rho. So yeah, expiration date, a very fundamental component of your options selection, whether you're selling or you're buying. Now, Jill, expiration's kind of become a different thing these days. I know when I first got into the business, expiration was kind of a monthly affair, and it was a big deal. It was once a month. Oh, it's expiration Friday, or if you're in indices, you had Thursday, but effectively that was it, and that was a big day. And I knew guys who would come in to only trade that day or that week, and they were usually premium sellers, the guys who did that. But it was a big deal, and it was something you planned for and set up for. You closed out positions ahead of time. Now we have the advent of more of these weeklies. You have Monday weeklies, you have Wednesday weeklies. It's become a different beast. Are you seeing a lot more questions and concerns about expiration now that it has really become almost a daily occurrence?
Well, you know what? We don't see as much of a concern, and people don't seem to be as intimidated by options expiration as they might have been before. And I think Dan and I actually touched on this when we were shooting this live with you in Chicago in October, where even though there's more products being introduced, and it certainly takes up real estate on your screens, the feedback that we're getting is the more fragmentation, the more product that's introduced, the more strategies investors have at their disposal. So I don't look at it necessarily as a bad thing or where people just aren't sure what to do with expiration. I think actually when you have so many different types of products introduced, they almost get used to the cycle. Of course, you're going to have it's going to certainly be more volume and more volatility around your quarterly or your regular way expirations, particularly your quad witch expirations. But I think people are just becoming conditioned to the fact that this expiration cycle exists on a more frequent basis right now. And I think that also lends to the significant growth that we're seeing within the options market for that reason. There's just more products simply to choose from.
Yeah, I will say I'm glad I'm not a broker these days, because having to deal with used to be the once a month those calls would come in. Now it's multiple times a week. You have to deal with what's going on with my Greeks, what's going on in my position, why am I getting a margin call, and all these fun. Now it's multiple times a week you have to deal with that fun. So I am glad I'm not on the brokerage side of the space these days. I don't know, Dan, are you on the same point tip as Jill there? Are you liking are you appreciating the advent of more expirations throughout the week? Because it does indeed give a lot more choice to your clients, your mentees, and indeed to you? Or are you maybe on the other side of the fence that maybe we're almost getting too many, and maybe it's getting intimidating or confusing to the newcomers?
You know, I will tell you what, when weekly started, I was like, holy cow, there's going to be a lot of expirations. And then when like the intra week, I guess you'd call them, expirations started, I was like, okay, come on, do we really need this? But the fact of the matter is, I think that people who approach the options market from now instead of from back when we started, Mark, where there was just monthly expirations, they're just used to it. They say, oh, well, here's the expiration date, so that's when it expires, and that's really the end of the conversation. There's not, wait a minute, I thought it was only expiration Friday, because newcomers don't even know what expiration Friday means anymore, So I feel like it's not as complicated as it was when it first started, having all these new and more frequent dates. And I don't know. I mean, overall, I think it's been shown to be good for the business because there's more trading. The more options you have, unintended, the more hedging opportunities you can have, the more opportunities to lay off your risk you have. And you see that, the more arbitrage opportunities you have. And you see that, and that just creates volumes for the exchanges, for brokers, for liquidity providers. And that volume that people see on the screens attracts more trading, and it's been shown to grow the business.
Yeah, I can only imagine how the business would look if we hadn't really embraced weeklies over the last couple of years, because you're right, they have been a huge driver of a lot of volume out there, particularly on the equity options side, a lot of premium selling in that range, but also on futures options, we see a lot of weeklies trading out there. It seems like pretty much pick your options product, short duration is where the action is. If they don't have a short duration weekly type product, they're probably in the process of adding one, because that's just where everyone wants to play these days, which is kind of interesting. Now, Jill, like I mentioned at the top of the show, this whole topic was kind of inspired by you guys and what you guys have been working on over there at NASDAQ. You mentioned it kind of at the top of the show, the notion of quad witch and triple witch. All these terms are really scary, Jill. I don't know. You're kind of scaring me with all these terms. So since you named your content after this, why don't you go ahead and explain to our listeners just what the heck we're talking about when what they're hearing when they hear these crazy terms like triple witching and quadruple witching. What's going on there?
I know it's actually more scary than it sounds, but just to run through the basics of it, the third Friday of the last month of the quarter could be a very busy day for traders. It's what we call quad witch. So this would occur on the third Friday of March, June, September, and December. And as a reminder, that's where we shoot live throughout the day on Twitter at our Philex trading floor, one of the last open outcry floors around there. And basically what that means, there's 4 different legs or 4 different types of options that expire, including equity options, index futures, and single stock futures. But for the most part, what we're focusing on are the equity and index side of it. Traditionally, and again, like you and Dan had mentioned before, because there are so many products out there, it doesn't even occur to people that you have regular way or quad witch. But unless you're like on the significant asset manager side of it, when you're really maneuvering around your index positions. But traditionally, they have been some of the busiest days in terms of volume, and they still continue to be in terms of volume, especially June expiration, because you have all the other index rebalances. But it doesn't necessarily mean that the markets will see more volatility, as quad witch is more of a liquidity factor, I would argue, versus a volatility factor. And we certainly saw that throughout all of 2017. And for a little bit more history behind that, the last hour of the trading session is what is referred to as quad witching hour, and that's really what I was referencing before. It's where traders will attempt to unwind those futures and options positions before they expire, and frequently put new contracts on to replace the closed ones. But I would also argue that you're going to see more of that on Wednesday or Thursday leading up to that. So, you'll be looking at volume today, tomorrow, and really why you see this volume surge is it's the combined effects of exercise, delivery, you have your hedging and arbitrage, and that will affect the underlying security to certainly boost in volume itself, and you could potentially see some volatility around that. That's why you get the term witching hour. You have all those forces at work. But again, I don't think it's necessarily a vol event as much as it's more of a liquidity and volume kind of event.
Now, you mentioned a lot of the beliefs and myths and misconceptions that float around options. A lot of them tend to stem from expiration. A lot of people out there tend to have this belief that options are these powerful gravitational forces, these black holes in the stock market, and they can move the stock market wherever they want, and that power is just magnified on the day of expiration. That's when stocks just get sucked to these strikes. A lot of these different versions of this theory out there. The big one is probably the Max Payne theory, a very, very controversial thing that says options are effectively going to go to the point which causes the most pain for the long options holders. So typically a strike with a lot of high open interest. If you sit on that strike, it's going to decay, go to zero. That's going to cause a lot of pain for the buyers on that strike. Obviously, conversely, the sellers will be kind of happy. This one's a bit controversial. I think we touched on it a little bit before. Dan, what are your thoughts on this Max Payne theory? Are you a buyer? Are you a seller? And then also B, just kind of this general whole microcosm of myths that have sprung up around the market-moving power of options around expiration and just how terrifying all of that is. What are your thoughts there, sir?
Boy, I hope I have a long time that I'm able to talk here.
I've budgeted you 28 minutes. Go for it.
Perfect. So the Max Payne theory, which even saying those words just kind of annoys me a little bit because it's a little bit of like a hack, like amateur concept developed by I don't know who developed it, but they don't know anything about options because it's really built on just like fear of the unknown. But the thing they don't know is an actual phenomenon that they should know if they're putting money into trading options. So anyway, here's what I'm talking about. This Max Payne thing is, the stock just magically goes to the place where it hurts the most people, as if like there's some voodoo hex on it. Absurd concept. It's somewhat rooted in an important concept, though. It's this idea of pinning. So if you look at, and there's been studies done on this, although some of the studies were based on false logic. But there's an observation that if you look at where underlying settle on expiration days, particularly big expiration days like quad witching or the monthly, or like when leaps expire, the big expiration days, they tend to settle at or pretty darn close to a strike price, which statistically is unlikely, with a frequency that's more often than statistically it should be. So that's where people who don't really know how the options market works say, oh, well, there's some magic or voodoo or bad guys or, I don't know. They come up with all these crazy theories, call it Max Payne or whatever, for why this happens. But it happens because liquidity providers, market makers who are long gamma are scalping. They're scalping their gamma so that they can stay flat and manage their risk. They're trying to not lose money, so they're being responsible and hedging their gamma. And when the underlying goes above the strike, they get longer deltas, so they have to sell, which pushes the stock back down. And then when the underlying goes below the strike, they get short because of their gamma, and they have to buy the stock, which pushes the stock back up. So all they're doing is just trying to be responsible risk managers and not lose money, but it does cause the stock to go to the strike price. Now, is that because that hurts everyone or because there's a voodoo hex on there, because there's some Max Payne theory? No. That's the actual market mechanics, the actual behind the scenes of why that phenomenon occurs. And so since this is the Mythbusters show, that's probably the best thing we could talk about because that's one of the craziest myths that you see brought up all the time, all these crazy theories of why you see frequent pinning.
Yeah, pinning, that's an interesting topic. I want to get to that in a second. But first, Jill, what are your thoughts here on this? It could be max pain, or maybe even more generally, just this notion, this persistent belief out there that options are really the huge market movers on days of expiration, and they're going to drive indices, they're going to drive underlyings to these crazy values just because that's how the options line up. Are you a believer in those types of theories?
Right. I'm not a believer in that either, as Dan had suggested. I think it's more hype than anything else. And again, the reason why we're seeing this kind of volume is it's just people adjusting positions. It doesn't necessarily mean that they're pinning to a specific price. A lot of the times they're just rolling over to reinitiate what's going to be closed out. And I think that's why, people get concerned, and then the media gets wrapped up in it at the close on expiration or Quad Witch Fridays. You're seeing this surge when it's really just moving into the next month or simply closing out positions. So I don't think it's anything more voodoo or more magical than that, to be honest with you. So, I'm kind of behind Dan on this one.
Yeah, you're right. If there's any myth busting to be done, I think we could spend a whole episode just talking about the expiration myths. But one of the things you mentioned, Dan, that is really important. One of the reasons why it is important to debunk these types of myths that options are just going to magically suck the underlying to the point of highest pain or most OI or however you want to view it. Things do pin, as you mentioned, probably more than they should, but it is, of course, the gamma effect more than anything else, and certainly not every time. And it's not going to make the underlying move 20, 30% in some crazy jump just because there's a high OI strike somewhere far away from the at-the-money. But you did mention the pinning, and that is something that's worthy of discussing and worthy of note. Pinning, a.k.a. pin risk, is an issue we used to have to deal with a lot as market makers, a little bit less so now that the exercise thresholds have changed. In fact, maybe before we even get to pinning, let's discuss that notion of exercising, because it's kind of the other side of the coin of expiration. When expiration Friday happens, what happens? A lot of your options are going to expire worthless, or if they're out of the money, or indeed if they're in the money, you're going to exercise them, or they're going to be exercised for you. Now, back in the day, it used to be if they had to be a nickel or more in the money, and then the options would be automatically exercised for you by the OCC, and your broker don't have to lift a penny, and they don't have to lift a finger, I should say. Then a few years back, they realized maybe we should tighten that window. A lot of people were falling through the cracks in that nickel-wide thing, so of course they had a dime on either side of the closing strike, in which case some people could easily fall through that cracks in the dime, so they tightened it to a penny. So these days, you don't really have to do much if you're an options trader and you want to have your contracts exercised. If they're even a cent in the money, they will be exercised for you unless you give some instructions to the contrary. You don't want that stock or you don't want to sell that stock. But that's something you don't have to worry about. You don't really have to do much. But when you get into expiration, something we talked about on this show before in the past, it probably would behoove you to probably close out all those positions before you even get to that point of exercise. And one of the reasons that you should do that is for this concept called pin risk, which is when the underlying closes exactly on that strike. That's when it's said to have pinned. Let's say XYZ is trading 100. You're short a bunch of 100 strike calls, and guess what? The underlying closes exactly at 100. Well, what do you do now? You're kind of in a little bit of a weird scenario because you don't know what's going to happen. Your options are not going to be automatically exercised because you're at the strike itself. So you have to choose what to do. Do you want to buy some stock to maybe hedge against having to sell it because you're short these calls? And particularly, the pin risk is really shown on the short side. That's really where it gets really most dangerous for a lot of the listeners because they don't know what's going to happen. They don't know if they're going to be assigned on those stocks. All of a sudden, in the case of short calls, you're going to get short stock. In the case of short puts, you're going to get long stock. It's all very confusing and very difficult. Dan, I'm sure you probably, somewhere in your years of education, probably have a webinar somewhere or an article about pin risk. Again, it's a little bit easier now that we have the tighter exercise thresholds down to a penny. But what are your thoughts on pin risk, the frequency that it occurs, and whether it's a big deal and what you can do to really avoid it these days?
Yeah, I mean, pin risk is one thing you have 100% within your control. If you are short an option, so Mark gave a really good definition of pin risk. If you're short an option, it's basically if the underlying settles at the strike price, you don't know if you're going to be assigned and end up with a long stock position and come in Monday morning down $10,000 because it moved against you, or the option is going to expire on you, and then maybe the stock moved your way and you wish you had a stock position. So it's a real risk. how do you avoid pin risk? If pin risk is the risk of being short an option that is at the money on expiration, how do you avoid pin risk? I've got a solution. Don't have an option that's short the at the money strike on expiration. You don't have to have one if you don't want to have one. You know, how do you avoid getting run over by a car in the middle of the street? Don't stand in the middle of the street. It's pretty easy. So all you got to do is do a little bit of position management on expiration day. If you're short options, if it's close to the strike price, buy them back for a penny. I mean, some people say, but wait a minute, then I'm leaving money on the table. You're leaving pennies on the table, and probably your broker doesn't charge you any commission to get out of those. I mean, I'd say, I don't know what the percentage is, but probably half the options-friendly brokers out there don't charge you commissions to close out short options under a dime. So you have complete control over that. You have no business being short at the money strikes. You never should have to worry about pin risk.
Yeah, you know, it's totally true. It is 100% under your control. I don't know about you guys, Dan, but when I was on the trading floor, we used to be maniacal about that. We used to close out anything that was even remotely close to having a chance of going in the money on expiration. So we were probably crazy about it, but we close out anything. I'd go up to brokers, can I get this 3-lot back? You know, they'd hate me. But we do it. We close out all that stuff because you didn't want any of that risk on your books. It's just a sensible approach. If you're out there as a retail trader doing 5 or 10 lots or even more, that same theory really applies to you guys. You know, there's no reason to carry this risk through expiration to subject yourself to the potential for pin risk and then be sweating in the after hours. Should I buy some stock to hedge? Should I sell some stock to hedge? What should I do? What's going to happen in my position? Am I going to come in Monday long or short a bunch of shares because someone decided to assign these options to me or call my stock away? All these things are out under your control. And if you close out, do a little bit of position management, close things out ahead of time, then it's a easier road to hoe. And of course, we touched on exercise. I suppose we touched on auto exercise, really. We probably should really quickly do an overview of the basic types of exercise as well. You have American versus European. Those are kind of the two standard flavors out there that most of our options market falls into. Jill, I know you guys are doing a lot of content over there on subjects like this week. You want to break down American versus European options for our confused listeners out there?
That was exactly what I was going to follow on to what Dan was saying, is that I think a lot of rookie options traders will fall into that trap where they don't realize the difference between American and European, and we get so married into the expiration date that we see within the options chain, not realizing that you don't have to hold options to full expiration if you're trading what's called American style options, where they will expire on the date that's specified in the contract, but you do have the option to exercise them earlier, whereas European, they expire on the day that it's specified in the options contract. So I think that's what I've heard before, and I've had people ask me, we didn't realize that you could exercise prior to that date. And I think that would save a lot of people time, particularly when we're talking about theta before, and losing some option value that way, that understanding those unique differences will certainly make it a little bit more manageable, and not, or potentially to avoid some of those costly kind of problems there. And for the most part, retail traders, they are trading stocks and ETFs. Those have American style options. And I mean, the broader indices, very few have American style options. For the most part, they're going to trade European style. But for the most part, your retail investors trading underlyings that consist of equities and ETFs, and they do have the option, if you will, to exercise at any point or what have you with the position. So I think that's a really important distinction to make, and it goes back to what Dan was saying before. There's no reason to hold certain options positions all the way to the end. It's just a costly proposition.
Yeah, that's probably another topic we can probably spend a good chunk of a show on, which is, of course, when to exercise your options early. Maybe that's another topic for another show. We can really sink our teeth into a little bit, the methodology and some of the voodoo that goes into determining when to exercise your options early. Spoiler alert, we'll do the quick version right now. You really shouldn't. If you think about it, particularly if you're a long options holder, you think about that listener, that's, of course, the only ones who can exercise are the ones who are long. It's effectively like closing out your position right now. So you're losing all of that time value. If you have another month or two left on your contract and you exercise it now, all the extra volatility premium, all the extra cost of carry premium, everything else that's built into that strike, the extrinsic value, that's all gone. You've given all that up. So you might as well, you're always usually better off selling that in the marketplace to get that extra little boost, except for when there's a dividend involved. And I think we could save that for another episode because there's a little bit more explaining to do on that topic. So I think we'll table that, a good topic for another show. But since I think we had a good little rundown here, busting some myths on all things expiration and exercise and quad witch and all these scary terms. Before we jump on to some of your questions, Dan, any last thoughts or takeaways you want to leave our listeners with when it comes to the subject of expiration and the many myths there around?
No, I mean, just to kind of like put one more nail in the coffin here on what you and Jill were just talking about. I am always a fan of closing out options early because it's not just worrying about pin risk and at-the-money options. Like American options, or if you own a pickup truck, we just call them American options. Not that I own a pickup truck, but,
you do live in pickup country. I'm on the cusp here, like a couple miles further south from my house. And so anyway, like options can be exercised at any time. And there's plenty of times where, people are holding me short end of money options. And next thing you know, boom, they're assigned and it's a big disaster. So close them out early. Good words to live by. Jill, and like I said, you guys are producing a lot of content on this topic right now. Any thoughts you want to leave our listeners with, any takeaways when it comes to the subject of expiration and the many myths and misconceptions therein?
Well, this is something that we also spoke about. We had a pretty interesting couple of hours in your office when we shot 2 episodes, but Dan and I were talking about this here too. Another natural way to think of it is, and I think we could do a whole other episode on this, is, there's this conversation around using options today or swing trade, right? So just by that virtue of that conversation alone, you know that it's not something that you have to hold to expiration, right? And so I think that's something that we should totally explore for another episode, because not only are you're looking for clues in the options market, but it also brings you back to, stock guys that are looking to get into options trading, looking at your fundamentals and your technicals to help you make these decisions for day or swing trading options. I realize it's a little bit more advanced in this conversation, but just by the virtue of being able to do that, you know that you have the opportunity to exercise or get out of a position earlier than having to hold it to expiration.
Yes, and the other thing we can do is hold on for some of your questions. Luckily, we got a ton of them, so I want to make sure we give you guys a little love on the show, too. So without further ado, let's keep on rolling right on into the mail call.
Mail call. Time to look at questions submitted by our listeners.
The old 4th of July music. I love it. Feels very festive, very patriotic. We're lighting off some sparklers here in the studio as we speak. Hopefully the sprinklers won't go off before the show is done. Of course, this is the mail call, the portion where you guys hit us up. You know how to do it. Add options on most of the big social media platforms, the email questions at theoptionsinsider.com via the live chat if you listen in there, or pretty much by carrier pigeon, however you want to get at us. You guys also via the website. There's the feedback form on our website there as well. Maybe you want to go through NASDAQ, hit up Jill and send them to us that way too. They all get to us here on the show at the end of the day. And you guys have some many wide and varied topics you want to talk about. Let's see. Where shall we start? Here's one that's actually I'm going to jump down a little bit because here's one that's kind of related to what we were just talking about. It's a nice little palate cleanser to kick things off here. This comes from Christina Rico. She wants to know, will we ever have daily options? And this gets back to what we were just talking about, which is, of course, the increasing frequency of expirations. And in many regards, we kind of already have this to a degree. Like we mentioned earlier, it started off, it used to be expiration Friday once a month. Third Friday, that was your expiration, that was it. Then we started adding weekly. So now we had every Friday, every once a week was expiration. Then we started adding Mondays and then Wednesdays. So, excuse me, we're at the point now where We're getting pretty close. If you buy a Wednesday weekly on Wednesday, you are trading a daily option. If you buy a Monday weekly on Monday, you are trading a daily option. Obviously, we're missing a few days of the week there, Tuesday and Thursday to be precise. So, but we are closing in on this. Jill, maybe we'll start with you. You are our resident exchange guru here on the old panel. First off, if you want to break any news for us about daily options coming out of NASDAQ, have at it. But then B, seriously, then B though, what are your thoughts here? Do you think we're going to get there anytime soon where we have expiration every day of the week?
You know what? I can't speak for the exchange, obviously, but it would not surprise me to see that it's a business at the end of the day, and they're constantly going to look for ways to figure out a new product to bring on board. And for the most part, like you were saying before, we're already trading dailies, right? You can virtually design a trade yourself and turn it into a daily if you want to. But I would, and again, the feedback that we get, not only on the retail level, but on the institutional level, they seem to like it where there's more product and more fragmentation so that there's more strategies to work with. So it would not surprise me. There's no immediate plans. This is just me talking as Jill. But, based on how receptive people have been to more product, it just wouldn't surprise me.
Does seem like we are trending in that direction. Mr. Dan, are you think we're going to see that anytime soon? Maybe even in 2018? And if so, are you pro or con that decision?
Well, I mean, I wouldn't be terribly surprised if we saw them even as early as this coming year. I don't know. I mean, I'm kind of indifferent. I mean, hey man, if they want to list them, then go ahead. I mean, is it more confusing? Not really. Just look at the expiration date when you're analyzing your trade, and you know when the expiration date is. Kind of what Jill just said and what I was alluding to before. I think that in some ways the fragmenting of liquidity actually kind of synergizes and creates more for the industry as a whole. So I don't know. I mean, you can make a case for either way. I feel like, do we absolutely necessarily totally need them? Not really, but do they offer more flexibility, more choices, and more risk management ability? Yeah, probably.
I'm going to go out on a limb and say by the end of 2018, so about a year from now, we will have effectively one exchange out there will have gone the extra mile and added effectively daily options. Who it will be, I don't know. Maybe it will be NASDAQ. Maybe it will be CBOE and then the SPX, somewhere like that. But so I do think, as Jill mentioned, it is a business. Businesses need to grow, and they need new products, and weeklies are the products everyone loves. So more of them probably will be met with enthusiasm, even if there is some reluctance for some people in the initial blush. So I'm going to go out on a limb and say by the end of 2018, we may see this out there somewhere. So hopefully that excites you, Christina, or maybe you don't say how you feel. Maybe you're anti. I don't know, in which case you'll be very sad. But either way, I do think it is coming, and if not by the end of next year, certainly within the next 2 years, I would think we will definitely have it. All right, let's go to, like I said, we got topics and questions all over the place. This one comes from Ian Nichol. He's asking about one of the more popular ETFs out there these days. He says, I have a question for Options Bootcamp. I love the show. What do you guys, and he put in parentheses, oh, and lady, look at that, Jill, getting a little love from the audience. Think of this VXX debacle with FINRA and Wells Fargo. Seems like a few folks at Wells Fargo should have been listening to this show. If you're not familiar with this topic, he sends a link to this article. I forgot where the article was from, but it talks about FINRA. We did touch on the story a little bit a few weeks ago when it broke back on our Volatility View show. Of course, VXX is, of course, one of the most popular, if not the, on some days it is the most popular ETF. Not even volatility ETF, just the most popular ETF out there. It does a lot of paper. And, excuse me. So it's a very popular product, but people have this mistaken assumption that they can use VXX as a long-term speculative tool on the VIX itself. And as you mentioned many times on our volatility show and sometimes on this show as well, that doesn't work out too well. The VXX is a product that tends to erode based on the shape of the futures term structure. I don't want to get too deep into the weeds in that. On this program, if you're interested in the VIX futures term structure, by all means tune into our Volatility Views program. We talk about that extensively on that program. But the issue here was that these FINRA, which is the Financial Industry Regulatory Authority, this is probably about a month ago when this news broke, fined Wells Fargo, the first ever fine related to a volatility type product, and at least a volatility ETP here, and said, you know what, you advisors are recommending people to buy and hold this product, and that's exactly almost the opposite use case for what it was designed. And they find these guys. They find them almost $3.5 million. Now, the activity was a little while ago. It was back July 2010 to May of 2012, so it's not recent. Hopefully, they've learned their lesson over there. But I think it is maybe an encouraging sign that we're seeing bodies like FINRA that should be on the more sophisticated end of the spectrum are actually starting to awaken to the risks posed by some of these products out there and the lack of education that is just omnipresent out there when it comes to some of these more esoteric products. And they're starting to crack down. That's good. And that shows an increased sophistication on the part of the regulators is always a good thing here. Again, not exactly, we don't get into the volatility ETPs too much, but still an interesting story, an interesting development. Hopefully we'll see more of this coming out of the regulators as they crack down on the misuse of specific products. I know, Jill, I know this is, you guys look at a lot of different ETFs over there. I don't know how much you look at VXX, but probably some. Any thoughts there on this, and as well as maybe the signs that increasing sophistication on some of the regulators to be able to crack down on this kind of thing?
This is a topic that's near and dear to me because it's so widely misunderstood. And Dan, you and I know when we were together at the street that I think we wrote about this topic probably more than anything else. Is the fact that it's just so widely misunderstood, and it's marketed wrongly as, let's say, an overall hedge to a portfolio, where even if you take a look at the prospectus, this particular product and all of the vol-based ETNs are good, if anything, for intraday trade. Because of the way they're designed and because they're based off the futures, they're naturally going to roll themselves into oblivion, or as Mark Sebastian would say, has a Sisyphus effect. I think if you look at VXX, it's down 99.5% since inception. So while it might be a good tool to trade, whether it's the ETN itself or options on the VXX, SVXY, UVXY, and all the others, they might be good for a very, very intraday trade, but to use it as a hedge on a long-term portfolio, because of the way it's based on the futures and the properties associated with that, I think you are better if you're looking for a basic hedge rather than look at the vol-based products. Look at something on, SPY or the Qs or simple ETFs positions as a hedge versus going to these vol-based ETNs looking for a natural hedge. I think they are, they serve their purpose in the intraday world of trading, but they are definitely not a long-term retail hedge.
Yeah, Dan, I'm sure you've encountered this more than once from a newcomer coming to your shop there, wanting to learn about all things volatility and VIX, and then wanting to use VXX to do that. They probably want to buy and hold it in their IRA. So, A, is this a topic you probably encountered before? I'm guessing it is. And then, B, what are your thoughts here on FINRA cracking the whip here on Wells Fargo for their lack of education?
Dude, if I had a nickel for every time I had somebody come to me saying they want to hedge their Apple position with VXX because they read about it on the internet or something. Holy cow. I need a lot of freaking nickels, let me tell you.
The old Apple VXX trade. Huge trade.
Hand to God, I had that happen. Hand to God. So there was an article. I've cited this article. I might have cited this article on a Bootcamp episode before. I've cited it in some of our classes. There was an article a couple years back now. I forget how long ago it was, 3, 4, maybe even 5 years ago. But Robert Whaley, who is the guy who, in conjunction with the SIBO, invented the VIX and then subsequently invented VIX futures and options in conjunction with the SIBO. Really super smart guy from Vanderbilt, I think, University. He, the father of volatility products, he was quoted citing that investors lost, it was something crazy back then, something like $2 billion or something. I mean, don't get too hung up on the number. The number I'm throwing out is wrong, but it was an absurd amount of money. Investors lost an absurd bunch of money by buying and holding volatility futures or getting into the options, like doing it wrong, doing it the exact way we're talking about. They were never invented to do that. Like people get a little bit of information, or worst case scenario, they have a broker or advisor who says, oh yeah, here's some brilliant idea. Let me tell you something. If your investment advisor has ever told you to buy and hold VXX as a long-term investment, fire him and call me and sign up for one of my classes and I'll set you straight.
Well said, sir. Yes, it is an omnipresent problem. You're right. Whaley has come out again. He's actually tried to create products of his own to try to correct that misperception around VXX. You could trade his. Didn't work out too well, but the people have tried for a while there to try to, tackle that issue. Speaking of tackling issues, we got some issues in our questions here. Got some fun ones. We are kind of running up against it. So tell you what, I will give Jill pride of place, and she suggested the topic today. I'll let her choose between which of the final these two questions here we're going to answer. So Jill, do you want to talk about the dangers of trading straddles, or do you want to talk about how we can get more ladies into options? Your call.
I like those both, but I will take how we get more ladies into options because this is good for everybody.
All right. Well, the question is pretty simple. I like the handle, TradeHer, saying, how do we get more ladies into options? So it's a good question. There are many different approaches. We see a lot of this now, a lot of different industry conferences. We have Women in Finance. There's that Women in Listed Derivatives group. So this is a growing effort out there. I know whenever we do studies and surveys and look at the demographics of our audience, it still is probably about 80 to 85% male. So the female participation rate is growing, but it still is predominantly a male occupation and predominantly a male interest. So, Jill, you're a resident lady. You get to speak for all of them out there. What are your thoughts here for TradeHer? How do we get more ladies into hashtag options?
Well, you know what the thing is? You already got over the first hurdle by simply asking those questions. And I know that it could be intimidating because options trading in general, has been viewed as more of a male-dominated kind of thing, but it absolutely is not anymore. We're seeing that on the trading desks. We're even seeing it on the floors and the technology behind supporting the floors with groups like Wild and just the talent pool that is out there as exchanges and floors become more diverse and really recognizing the talent and the expertise that women have. But for the retail female investor looking to get involved, ask questions. There are so many tools and applications available through your online broker that we never even had as professionals even 15 to 20 years ago. The tools that are available for retail traders now are even more sophisticated than we possibly had. So I think that you're in the sweet spot right now to get involved. I think it's really important to read as much as you can, join on podcasts, look on social media for credible sources such as Options Insider, and of course what Dan is doing over at Market Taker. But I think educating yourself first, paper trading, understanding the concepts before pulling the trigger and committing capital are the most important things that you can do. And, looking for credible support groups and other online resources that you can use to really leverage and take advantage of.
The nice thing about being an online source like what we do here on the Options Insider is not really intimidating at all. You can listen to it at your leisure. There's no scary instructor barking anything at you or anything like that. There's no big group of people maybe are afraid to raise their hand in. You can listen. You can kind of do it at your own schedule. And if you have questions, you can always hit us up. But that said, Mr. P, are there a lot of ladies coming to Market Taker mentoring? What are you seeing on the lady front when it comes to options and adoption?
Yeah, I don't know exactly what the breakdown is, but we've got a number of female students, and a lot of them, they come in and they join our chat room, and they're able to interact with some of our other traders, and I don't know, they seem to be doing as well as anybody else. I mean, I don't demand people show me their statements, but a lot of them have been saying, hey, thanks for all your help. I made some money this much. I appreciate it. And you see them chatting within our community. So there's definitely a presence, probably more than there was a few years back. So, yeah, looks like a growing trend for sure.
All right, listeners, that music means we're going to have to leave it there. Great questions, as always. You guys really took us in a lot of interesting directions. VXX, bringing ladies into the fold, always an interesting initiative there. Daily options. We have a lot more questions we didn't even get to. Don't worry, listeners. Excuse me. We read them all. We try to answer as many as we can on the show. We did that big mail call palooza not too long ago. Can't do that every episode, even though that would be fun. But keep those questions coming in. If we don't get to answer them here, we'll answer them directly or maybe on another show or things like that. We'll keep the questions flowing so you guys can, and the answers flowing, I should say, so you guys don't have to wait too long. Even though I know a lot of you guys like to bombard us on this show specifically, and we love hearing from you guys. But before we go, let's go back around the horn one last time. As we mentioned a couple times on the show now, Jill, you guys over there at NASDAQ are really going whole hog into the expiration topics this week. If our listeners want to check out what you guys are doing and all the different content you guys are putting out there on this subject, where should they go? What should they do?
They should follow us on Twitter and Facebook at NASDAQ and at Jill Malandrino, all one word, and join us every Quad Witch Expiration Friday at the NASDAQ Felix Options Trading Floor, where we put out live content on NASDAQ's Twitter feed all day long, including myself. We co-host with special guests. This expiration will be co-hosting TD Ameritrade. We have a number of ETF and RIA experts joining us, so it's literally like a full couple weeks worth of content packed into one amazing day.
Check it out. Follow them at NASDAQ, the best place. Check that out. One of these days, Jill, I have to make it out there to that new Philly floor. I haven't seen it yet, but it looks pretty cool.
I need to host you. That would be awesome.
We'll turn the tables on me. There we go. That'll be kind of fun. But I do want to check it out. The newly revamped Philly. One of these days, I will make it out there. I promise. And last but not least, I'll also one of these days head out to the pickup truck land where we find the HQ of Market Taker Mentoring. Mr. P, what's cooking over there in MTM? And what do you want to leave our listeners with?
Oh, it's this time of year. We're wrapping up the year, and we actually have a really great end-of-year special, I guess you'd say, going on. We're actually giving 50% off any new class to any student, with the exception of our one-on-one coaching, maybe a couple other, but just about all our classes. So if you go to our website, markettaker.com, look at the Learn to Trade tab, you can see some of our classes there. Or if you're on our email list and you were made aware of some of our classes, you've been waiting for the right time, right now is the right time. Just use the coupon code HO, all caps, HO, and you get 50% off. So, yeah, please take advantage of that.
Not a bad deal. 50% off. Ho, listeners. Keep that in mind as you head on over to Market Taker Mentoring. Grab those deals while they're there. And on behalf of Jill and Dan, and indeed myself, I want to thank all of you out there for listening, for downloading, for streaming, for course, for sending in so many great, many, and varied questions. Keep them coming. We do like hearing from you guys. And we'll see you next time for more Options Bootcamp.
Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.